The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we saw the grains and oilseeds slightly to moderately lower on Wednesday's trade. We did get a little bit of a bounce back in cattle futures, some spread action in feeders and hogs as well. Mixed action there with some spread trade, it looked like as well. We have a lot of geopolitical things that we're paying attention to in Europe with Russia and Poland and other NATO members, and plenty of things to unpack. Plus, we got a WASDE report on Friday. Let's talk about all of this. Joining us now, Mike Zuzolo with Global Commodity Analytics for our weekly conversation. And Mike, good to have you back on. Just when I thought it was going to be a quiet week into the WASDE report on Friday, we got some geopolitics, some issues out there that may be making their way into the trade a bit here on Wednesday's close, Mike.
Yeah, and how odd it's this is all coming to kind of a head, not just ahead of the WASDE, but also ahead of 9/11 anniversary as well. But, I think we can connect the dots pretty well here, Jesse, in that the news overnight from President Trump wanting the EU to put 100% tariffs on China and India in an effort to cut off the oil revenues and cut off the funding of Russia's war machine, also comes together at the same time as these drones from Russia come into Poland airspace, and Polish leaders are saying this is the closest they've been to war footing since 1939. If you add those two things together and then put the common denominator underneath it as the U.S.-China trade negotiations, you can probably say at this point, the likelihood of us getting anything done with them is very, very remote at this stage of the game, especially if EU does go ahead and institute these tariffs on China and India. And why I bring Poland and the drones into it is because, as you say, that's a NATO country, and the EU is already wanting the U.S. support when it comes to the Ukraine-Russia war. I think it adds a lot of likelihood that the EU will move forward with these trade tariffs on China and India, and meet what President Trump wants because of what's happened. I think Russia putting those drones in Poland actually probably added to the likelihood that they would see some repercussions from what's going to happen to China and India, would be my guess right now. So this all worked, I think, into the price action of soybeans, and that the soy really didn't perform well at all Wednesday. And I got the feeling even before Tuesday's close that corn and wheat had kind of checked out of the hotel. Unless beans were going to do something to the upside, they were just going to wait for the report until beans made a move one way or the other.
Now let's talk about this bean complex a little bit. And dare I say here, Mike, that soybeans are maybe in the weakest position of the three major commodities right now, with corn and wheat obviously not in a great position either. Really, the entire ag economy is not in a great position here, but I feel like soybeans are maybe the weakest leg of the stool. Talk about this a little bit.
Yeah, I mean, I think they still are, just because of the world supplies and the lack of a trade deal. Now, granted, Brazil's Paranagua price for soybeans is about $1.10 higher than where we're at in the Pacific Northwest. And we have to acknowledge that when you look at Nebraska, Kansas, October soybean basis of 80 to 90 under, you go north into South Dakota, it gets to $1.10 under, and then you go even north into North Dakota, and I've seen as bad as $1.50 under. You've got a lot of negativity priced into the actual price of beans when it comes to the cash markets, whether you're looking at the world price at the Gulf or these northern tier states that have been shut down because of the Pacific Northwest. Having said that, I do think that this chart would suggest to me that there's 2 years that are analog years. They've been analog years ever since the springtime. You can see how we were running back in the springtime neck and neck with 2018 soybean prices. And then instead of going lower in the later part of the spring, early summer, we went sideways, and that just drove us straight into November 2024 price action. And we're essentially moving in tandem with 24 and also in the same price as 24, plus or minus 20, 30 cents. And this is where I came up with the idea last month after the last WASDE report that this looks a lot like 2024 again, that the beans made the low. 2 weeks ago, beans cooled off. Corn took over as the leader to the upside. Now heading into the September report, corn is, as I say, kind of checking itself out, with the September corn doing a lot of strong lifting. But we need the beans again. And this chart really shows it nicely, Jesse, as you get to the yellow arrow where the September crop report is. You see not only in 24, but also in 2018, the market moved higher into the later part of September, early October. The problem with 2018 is that basis up north and the lack of business with China. Does USDA cut the demand again in the crop report Friday because of no trade deal, or do they feel like they've done enough and we see a yield decline instead and we get that second half of September rally? I'm leaning that way because of the dry weather, and I'm leaning that way because our exports in soybeans are at 1.7 billion. That's really close to where we were 2 years ago. I don't think we need to drop down to 1.5 billion at this stage and match up with 2018. But I'm going to take the market at face value regardless after that September report comes out if we don't get some yield reductions.
Well, looking a little bit closer at the daily chart here in soybeans, it's you see kind of the wedge pattern, and again, to your point about getting into the September crop report time frame, maybe that could yield us some moves that give us a little bit of stability, maybe, or a little momentum to the upside here, Mike. But it's hard to say.
Yeah, one way or the other, it's a momentum changer is what this chart is suggesting. And just going back to the fundamentals we just addressed, and we're talking about in corn, for instance, states like Illinois are the worst in 5 years in good to excellent conditions. Indiana's the second worst in 5 years. Ohio's the worst in 5 years. And beans are even worse than that because they're below last year's good to excellent numbers nationally by a point. And so one would think fundamentally that if USDA doesn't come in and crush us with a high yield number, that the coil that we see, the wedge that you're talking about in orange, that coil is kind of like a spring where it's getting more energy as it confines itself and condenses itself to smaller and tighter ranges. And we are there on that wedge. And we have tested that blue 40-day moving average 3 times in the last 5 trading days. And so that's a pretty big line in the sand for me. You notice at the bottom of the chart, the oscillators are very oversold now, having sold off after the last couple of weeks. So you would think there would be fewer new sellers coming into this market unless the USDA promoted the idea to go ahead and jump in. And I'll throw one other thing in. The yield reports, they're very early right now, but what I'm getting is very mixed, where the rains were good and the drowned out spots were not there. You're getting good yields, but where the rains either messed up your planting or didn't come, the group 3 beans, the group 2 nines, they're only hitting 50, 55 bushels right now from what I'm hearing in states like Southern Illinois and Kentucky. So it's a really interesting dynamic, but you can see the seasonal chart we just looked at, this November bean chart, the fundamentals, the technicals, they seem to be coming together. And this is exactly why I'm pretty much going to take this market at face value after USDA's numbers.
When we think about issues with war in Europe and escalation of tensions, I immediately think about the wheat complex. Your thoughts there? Anything stand out to you immediately here as we're digesting the situation and looking at world wheat values, things of that nature, Mike?
Yes, and you hit it on the nose. The wheat and the crude oil have not put any geopolitical premium into their market price. Wheat started to on Wednesday, crude oil started to on Wednesday, but the wheat market in September was bidding at 493.5. That terrible, ugly 3-year low that we have been bouncing off of for the last month and a half. And you can see where the European market and the Black Sea markets, they are all going down with the harvest prices and the bigger supplies coming on. But I would also say the French price in green has dropped sharply, and that's more quality. And I think that's skewing this market right now. But be that as it may, we have no geopolitical premium in the wheat and next to zero in the crude oil, in my opinion, given the stakes that we're running right now between the Israelis bombing Doha and now this with Poland and Russia, you just would think that some risk premium would come back into this market. But this is the age of the algo trader where they feel like they can put it in as soon as the news wire crosses.
We are having a conversation today with Mike Zuzolo from Global Commodity Analytics. Let's talk the corn trade before we go over to cattle, Mike. And corn still feels like it's holding up well, but we tie in corn with the wheat spread as well right now, heading into Friday's report. What are you going to be watching here?
Well, wheat's a feed grain again, Jesse. That's the problem. And that quality issue that France is having, it says to me, along with some other quality issues around the world, we're still going to have wheat tied around our neck if we're a corn trader because it's going to compete for feed grain. And that's something we're going to have to watch in these future reports by WASDE because, their corn total demand number is up to 15.955 billion bushels compared to 15.4 in their July report. And so if in the case of the corn, if the USDA wants to cut yield, which I think it should, given those crop conditions issues, given the disease pressure that the Iowa State crop progress report illuminated on Monday afternoon, I think they should be back down towards a 184, 185 number. But if they do that, do they also hack the demand side because they bolstered it and pushed it up so much in July? And that's where the wheat comes into play. Going below $1 a bushel, wheat over corn and the soft red wheat, that says to me wheat's still a feed grain and it's not getting any kind of traction as a food grain yet. So it's a competitor.
Let's talk livestock. Cattle, of course, had a pretty big down day on Tuesday, especially feeders locked the limit lower, but then we got a decent bounce back on Wednesday, at least mixed action. I mentioned this at the top, maybe some intermarket spreading in feeder futures. Live cattle had a good day. What are your thoughts as we look at this cattle trade midweek?
Yeah, I think the bull spread was very active in feeders, as you say, and it would make sense if it were because I saw at mid-session Beaver, Oklahoma had a large sale of 700-pound steers that went at 406. That was the third highest number in Oklahoma history. And so you still have this disconnect between the cash and the futures market in both feeders and fats. I've been asked the question a lot, obviously, after Tuesday's price action. Is this the top or a correction? And in both of our cattle charts, both our feeder and our fat charts, I've got some cycle charts, those orange ellipses. And I just want to say off the get-go, I like cycles, and I like the cycles in cattle a lot because of the production price cycle history that I've kept for 30 years. Every year's different, but I still like the cycles. I still think we're in a 2014, 2015 type year where we have ration demand. We just don't know how much yet. We have started to retain. We just don't know how much yet. But that's what we were faced with at the end of 2014. And we still sank about 18% in 2014, late 2014 into February of 2015. And so to answer the question of is this a top or a correction, does it really matter? If we have a 15% correction in feeders at $350, that's a $52.50 correction. That's worth going after. You can treat it like a top at that point. Mm-hmm. So that's kind of where I'm at right now.
Well, and you mentioned some cycle charts, and since we mentioned feeders there a little bit, let's look at the monthly feeder chart with some of these cycles here. Any key things you'd point out on this chart?
Yeah, this is the 7-year cycle in feeders, and you can see where I'm drawing my conclusions from with that 2013 low and how that up and then straight down essentially into 2015, late 2016, and then we essentially went sideways. And that's why our cattle cycle, our price cycle now has been elongated to the upside. So I think we've done the job of getting to the levels we need to get to for retention. But the most important thing in the short term, Jesse, are those 3 trend lines at the top of the charts where the latest part of the price action is. You've got a yellow trend line that's essentially vertical, followed by a white one, and then followed by a purple one. I've got a 3 trend line strategy or 3 trend line psychology when it comes to if there's 3 trend lines, either resistance or support, that's about the most you're going to get is 3 major trend lines, especially when you have that last one be so steep. And so if we're on that yellow steep trend line right now, if we take that out, I think it's highly likely, and we need to plan for that we go and we maybe even have to go back down to the purple one. But as we talked about before, if you go down to the purple trend line, you're still in an uptrend. And so you literally could correct $50, $60, $70, and you're doing nothing to the overall long-term trend. And I think that's really important to think about, whether you're using livestock revenue insurance and you want to re-own it, re-own the cattle and the feeders, or whether you haven't gotten your hedges in yet.
Let's go look at the last chart here. We'll go back and we'll talk live cattle prices, fats, and then this one has some correlations with boxed beef. We've looked at this chart before a number of times, Mike. What stands out to you here this week?
Yeah, you're exactly right, and it doesn't take a lot of explanation. We've got a cash steer market that is still well above the October lead month futures, and so again, we have that premium in the cash. As long as that holds up, and I'm expecting that the boxed beef market will not fall apart, and therefore the negotiated cash steer will hold together at current levels, then why would the futures want to go lower, other than the funds wanting to get out of their longs? And that may be what we're seeing right now. We just don't know. The other thing I would say is that 40-month cycle analysis, the purple ellipse, you go back all the way to 2013 there, in the fat cattle, it's a really nice looking cycle. It was more of a consolidation to a new leg up in 2023. And that was one of the things that I did not see at the time. But now you've gone parabolic in early 2025, and that cycle's starting to roll over. So these are warning flags, in my opinion.
How about that hog market too? I should ask you there. It's a market that has held up well amid some of the cattle volatility here recently. Any notes for you in cattle this week, or in hogs, I should say, this week?
Yeah, I'm glad you asked that, because we had fresh inflation data from China just today, Jesse, and the food inflation was miserable. The food CPI went down to a brand new 2025 low for China's consumer price index. And so that really suggests that they are not worried about needing to build up supplies, and their consumer demand is still very, very weak. It would also suggest they probably aren't in any hurry to try and rush and buy any U.S. agriculture goods unless they're a lot cheaper and they get a tariff, cut. I think this is where I'm still in the same camp as I have been for the hogs. Is you get above $100, you get close to $100, you start getting some floors in place.
Always appreciate the conversation, Mike. Anything final you would mention or reiterate to folks on the show today?
Just circle back around to the WASDE report. I think, if it's a 2024 similar market and we need to feed the bull and the beans, give the corn a rest to allow it to go up with some help, and hopefully the wheat market supports as well. Otherwise, be ready to do some off the combine sales that you're forced to do because you can't store it, and then be ready to buy back maybe as early as the October crop report.
Mike, if folks want to reach out to you for a conversation there at Global Commodity Analytics, what's the best way?
Best way is globalcomresearch.com. That's globalcom with 2 M's, research.com. There's a 2-week free trial sign up. Please sign up and give me a call.
Mike Zuzolo, Global Commodity Analytics. Always great to talk with you, sir. Have an awesome rest of the week, and we'll talk to you again next week.
Thank you, Jesse. You too.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.